Good morning to our financial advisors. Welcome to the Old Mutual Multi-Managers Virtual Roadshow. Obviously this year we are unable to travel, so we are broadcasting to you from the V&A waterfront. All right. Just a few pointers for the day. When you listen to the presentation, if you have any questions that you would like to ask, please type them in the comments box and we will try to get them during the day or after the presentations are finished. The second point for planners, we are going to be applying for CPD points for this presentation, so there will be an allocation of CPD points for you for this presentation. Obviously, things are a bit backlogged at the moment, so you will get those in due course. All right. Just a note, this part of the presentation is for financial advisors only. Remember, later on in the day, we're going to be doing a separate presentation for your clients where they will join via Zoom. All right. Just to quickly look at what today's agenda is going to be all about, we're going to start the day with an investment update on the fund performance and market performance from Maneen Watson, our Chief Investment Officer. She's going to be joined on stage during her presentation by our investment strategist, Isak Odendaal. They're going to have a little chit-chat about what's happening in the markets. We're going to then be joined by Michael Dodd, who's head of SA Equities. He's going to be talking about the SA equity market and what has happened in that market over the last year or so. And then to finish it off, we're going to have Andrea, who's head of our global equities. He's going to be talking about what's happened in the global markets over the last year or so. All right, so that's the agenda for today. After we have finished with that part of the morning, we're going to break, and then at 20 to 1, we would like your clients to join on Zoom, and then we're going to do the second part of the presentation to your clients. All right, thank you very much. Thank you for joining us, and enjoy the day.
Good morning and welcome to our 2021 investment update. The COVID-19 pandemic will define 2020. This time last year, when the coronavirus was raging in Asia, many of us hoped that it would be contained to that region, as had previously been the case with viruses that had originated in Asia. As we look back on the year, it's very evident that that has not been the case. But what has been surprising, that it's actually been Asia, and particularly China, that have come through this pandemic much stronger. If you look at the picture in the bottom right-hand corner, that was taken in October last year with tourists back at the Great Wall. A very different picture to what we were experiencing in the rest of the world as we struggled to contain the pandemic and the spread of the virus, with the resulting lockdowns that we could never have imagined in Western society, as well as the pressure that it put on healthcare systems. Our lives have changed in ways that are hard to recognize. Mask wearing, social distancing, and work from home are now the norms as you sit in your homes today. So with the severe impact and the dislocation we've seen on people's lives, jobs, and businesses, it's remarkable to see how strongly the markets have recovered and how quickly they've recovered from the lows that we experienced in March last year. This chart shows the returns in rands of the key asset classes we invest in. And you can see the sharp fall-off that we had in March last year, but then the recovery that we've seen since then. The strongest performing asset class was global equities, the dotted red line. This is clearly in rands, and the recent rand strength makes the more recent returns muted. But a very strong performance in rands from global equity, an asset class that was up 20% in the year. The black line is global bonds. We hadn't had any exposure to bonds, thinking yields were already very low. But in this environment, yields went even lower, with bonds doing very well, but giving back some of those gains during the course of the year. If we look at South African asset classes, the strongest performing asset class was bonds. Hard to imagine that SA fixed income and the All Bond Index has given you a return of close to 9% over the last year. SA equity took a bit longer to recover, the purple line, but by the end of the year was back into positive territory and has continued making gains during this year. The sector that has really struggled both locally and globally has been property. The yellow line is global property. It is a much more diversified asset class than what we have in South Africa. And our managers were able to take advantage of that through active management. And our building block actually managed a positive return in rands. The bottom of the chart is SA property. Clearly, that is where the devastation from the lockdowns has been most felt. And our property sector is concentrated in office and retail, which have clearly borne the brunt of what we've experienced over the last year. So how have we been positioned through 2020? We've maintained a neutral exposure to equity, which hurt performance in the downturn in March this year, but the overweight to offshore versus SA equity benefited returns, and since then we've seen a strong recovery from both local and offshore equity. We have favoured a full weight to offshore, mainly within global equity, maintaining a neutral exposure to property and having no bonds. As offshore outperformed on a relative basis in the early part of the year, we trimmed back that exposure and invested back into South African assets. Locally, we have favoured fixed income, given the juicy real yields that have been on offer, and have maintained a very low exposure to property, particularly within our property building block, though we have gained some property exposure via our fixed income building block as well as our equity building block. Throughout this year, in managing the funds, diversification has been front of mind for us. We have maintained our offshore exposure as economies and markets have been protected by the stimulus that we've seen, particularly from developed markets. And we've balanced this with the exposure to cheaper bonds and equity in the local market. So how have we done from a tactical asset allocation point of view? This chart shows the value add from tactical asset allocation. So being overweight global equity versus South African equity and an overweight to SA fixed income has meant that the funds have again gained from the positions we have taken on a tactical basis. We made a few manager changes in 2019. They've done very well for the funds in 2020, but made no further changes during the course of last year. It's encouraging to see that our managers have performed well during 2020, with our manager selection value add improving materially through the course of the year. This chart shows the returns over the last year for each of our key asset class building blocks. The bars in black reflect the benchmark returns, and the bars in green are the returns that were actually delivered in each of our strategies. SA equity is on the left-hand side and has outperformed the benchmark nicely over the last year, as has global equity, which is the second grouping of bars from the right-hand side. Our property managers have also outperformed, with our global property managers doing particularly well through active security selection in a sector that is much more diverse than what you have in South Africa, outperforming by close to 5%. The only building block where we've seen underperformance over the last year has been within fixed income, and I will speak to that in 2 slides' time. This chart is similar to the last one, but shows the returns over 3 years. SA equity is outperformed over that period. Global equity slightly behind benchmark over 3 years, but still ahead on a net basis over 5 years. And the property managers, again, ahead of benchmark. Last year's performance within fixed income means that on a 3-year basis, that building block is now behind the benchmark. So if we look at fixed income, there were some big moves in the bond curve last year. The blue line reflects where the yield curve was at the end of 2019, and the green line where it was at the end of 2020. One can see that yields moved down steeply on the shorter end of the curve, providing huge opportunity for capital gains. On the longer end of the curve, however, we saw yields move higher as the COVID crisis exacerbated the debt risks that we already faced in South Africa. Our fund was positioned on the long end, as pre the COVID crisis, we believed that yields already reflected the risk of a downgrade. But one can see the difference in returns between these sectors, with a sector like the 3 to 7 years gaining 16% over the last year, whereas bonds with a longer dated maturity only gaining 5%. We have a flexible fixed income mandate where managers are allowed to invest in each of the asset classes in the chart in front of you. Clearly, our positioning on the long end hurt returns. We also had some exposure to inflation-linked bonds as well as property, which were a clear underperformer over the last year. So let's bring that all together, looking at the performance of the strategies. We've divided the strategies into three main categories. In the darker green are the funds that target a lower real return. In the middle bar are what we typically refer to balanced funds. And then the grouping at the top are our unconstrained solutions. This chart has the performance of the lower targeted return funds. And on average, the funds gained about 7% last year, far ahead of inflation at 3%. What is encouraging is looking at the 2-year return, which is now at about 9% versus inflation of 3%. Really good real gains for investors coming off the lows of 2018. If we look at the funds now across all periods, they are ahead of inflation. The real challenge in terms of real returns has been within the balanced fund space. But even here, in a very tough year, the funds have outperformed inflation in the order of about 4%. What is encouraging is seeing that over 2 years now, the funds are on average 6% ahead of inflation. This is coming off a very tough year in 2018. The 3-year numbers remain challenging versus inflation, and on a 5-year basis, while funds are ahead of inflation, they are not meeting their targets on the back of poor performance from, in particular, SA equity over this period. Over the long term, the returns are still materially ahead of target. Lastly, we have our unconstrained funds. Here we have the multi-managers max return and SIS max return fund. And as the name suggests, these funds seek to maximize returns and are mainly invested in equity. We've had a big weight to offshore investments within these funds, which has benefited performance over the last 2 years with returns in the order of 16 or 17%. And if one looks over the long term now, they're decent real returns over all periods. The green bar is the SIS 3 to 5 fund, which became unconstrained in November 2019. We've thus had the flexibility to invest more in offshore in this fund, which has clearly benefited performance, particularly over the last year. So if we just look at the longer term and how the funds are doing versus their targets, for the SIS 1 to 3 fund, which represents the funds in the lower return targeted area, the fund is back within the target range with a hit rate of 83% over rolling 3-year periods. We're starting to see improvement in the inflation plus 3 to 5 fund with that green line moving up. The hit rate over all rolling 5-year periods remains high at 73%. Lastly, on the inflation plus 4 to 6 fund, an environment where equity has disappointed over the last 5 years means that this fund has continued to struggle to meet its target and will need sustained equity performance to see us reaching our real targets going forward. But if we look over the longest history of the fund, we have an 80% hit rate over all rolling 7-year periods. Lastly, we have the max return fund, and given the strong performance from global markets, that fund is now meeting its inflation plus 8% target over rolling 10-year periods. So how have we done on a peer basis? While our focus remains on generating real returns, it's important to see how we've done against our competitors. On this chart, we have the Old Mutual Multi-Managers Cautious Fund of Funds, as well as the SIS Inflation Plus 1 to 3 Fund. They are in the top quartile over the last year, over 3 years in the top half, and then placed in the top quartile over the remaining periods. So strong recovery across these funds and doing well versus peers. The Old Mutual Multi-Managers Defensive Fund of Funds is in the multi-asset medium equity category and has delivered top quartile performance over the last year. Over 3 years, we're in the top half with top quartile performance over the other periods. Looking at the multi-asset high equity funds, they've delivered performance either at the top of the second quartile or within the top quartile. Over 3 years, the funds are still struggling versus peers, but we're starting to see that performance improve nicely. Over 5 years, we're in the top half, and over 7 and 10 years, we maintain our good long-term track record. So looking at the numbers, we can see we've had very strong returns on a real basis over the last 2 years. The question is, can these real gains continue? We have an integrated investment process that combines strategic asset allocation, tactical asset allocation, and manager selection. Last year, we spoke in depth about tactical asset allocation and manager selection. And today, I want to focus on strategic asset allocation, which is at the core of what we do. So what are we trying to achieve with strategic asset allocation? It's about trying to find the optimal long-term portfolio that can meet your real return target. If you are not able to change the asset allocation of the fund over a long period of time, what would that asset allocation be that would get you closest to your real return target with the lowest amount of risk? To do this, we forecast the real returns for all the asset classes that we use in our funds using the longest possible history. We also look at the volatility or the risk of each asset class, as well as the correlation and how the asset classes move together. Looking at that long history, these are the real returns that have been achieved across asset classes over time. On the left-hand side, you have SA equity, which over the longest history has delivered a real return of 7%. On the right-hand side of the chart, with the green bars with the blue above topping them, we have the global asset classes. Global equity, over its longest history, has delivered a real return of 5.5%. The blue caps on top of all the bars reflect the extra return South African investors have received from the currency depreciating by about 1% more than the inflation differential over that long history. We use these real returns to do extensive modeling, looking at different ways in which history can play out to find that optimal portfolio. And this becomes the starting point of us managing the strategies. So what if asset classes delivered in real terms versus our long-term expectations? In this chart, we've looked at the real returns for each of the asset classes on the screen over a 5, 10, 15, and 20-year period. So if we start at the right-hand side of the chart with global bonds, one can see that over 15 and 20 years, global bonds have not delivered versus their real return expectation. But over the last 5 years, as yields have ground lower globally, bonds have actually exceeded those returns. If we look at global equity, over a 20-year period, it has delivered a real return of about 4%, just below our expectation of 5.5%. Over 15 years, it's in line. And then over the last 5 and 10 years, it has exceeded that target by an incredible margin, boosted by the returns from technology companies. Looking at the South African asset classes, we've had high real cash rates in South Africa, which means that cash has delivered beyond our expectation of a 1% real return over the last 5 and 20 years. South African bonds have also delivered returns over all periods in excess of those expectations. So if we look at South African equity, the real return target of 7% is a challenge. But over 20 years, that's largely been met. The disappointment has come through in the shorter periods, and particularly the last 5 years, when real returns have actually been negative for this asset class. So can those historic real returns be replicated for South African equity? If we look at the history of what has driven that 7% real return, it hasn't come from higher than average GDP growth, but rather from the fact that companies in South Africa have been very profitable. The recent low growth we've experienced has dampened that profitability. It's also been exacerbated in some cases by poor capital allocation amongst companies. But the question is that if growth can improve from here, to what extent can companies improve their profitability and get us back to those real returns? Ratings and earnings bases are incredibly low. If one looks at the capped SWIX, over the last 5 years, only about a third of companies have generated positive returns, with a median return over that period being minus 20%. So the earnings base and the performance of companies, as we know, has been very poor. But the South African market isn't just made up of domestic companies. We've maintained for a long time that our market benefits from global growth, and we've seen that recently in our mining companies and the global companies that are listed on our market. If we look at global equity, 20 years ago, we were in the middle of the dot-com bubble. Markets were expensive. And that probably speaks to the fact that global equity disappointed versus our real return targets over that period. In the recent times, as we've shown, returns have been a lot better. So we find ourselves today again in a place where markets look expensive globally. The question is, will earnings growth justify the current valuation? The way we approach global equity is to manage a portfolio that is diversified across styles, and I'm sure many of you are aware of the extent to which value has underperformed over recent years. We also have an underweight to the US with more exposure to emerging markets. So diversification has been key in the way that we have managed this risk in the global space. So having said this, how are we positioned? This is a chart that we show every year. Those dots are the ones I showed in previous graphs, which are the expected real returns for each asset class, where the bars are above the dots, the asset class offers value, where they are below. Simplistically, this graph shows that those asset classes are expensive. The global asset classes on the right-hand side, and except for global property, which appears fairly valued, the other asset classes globally appear on the expensive side, particularly in the case of global bonds. So if we look at the left-hand side of the chart, excluding cash, South African asset classes are offering a lot more value, but clearly this comes with a lot more risk in terms of growth that underpins each of these asset classes. So how are we positioned going forward? We have maintained a neutral exposure to equity with an overweight to global equity versus South African equity. Within the local space, we are still overweight bonds, given the real yields that are on offer in an environment where we expect inflation to remain contained. We have maintained an underweight to South African property. Whilst valuations look compelling, leverage remains a risk in this sector. As I said, in the global space, we are overweight global equity with no exposure to global fixed income and a neutral exposure to global property. I'm going to be joined now by Isak as we speak to the environment that underpins the prospects for each of these asset classes. So Isak, we're not epidemiologists, so we're not going to focus on the coronavirus today, but it goes without saying that vaccinations give us an ability to return to some kind of normal in the future. So we've said that global markets are looking expensive, so it's important to speak to that exposure. Companies are pricing in a recovery in earnings as they see a recovery in underlying economies as the vaccination kind of gives us a way to normal, as I said. What are the prospects for global growth from here, and what are the risks to a broad-based recovery?
Well, there's obviously still a huge amount of uncertainty around the pandemic as it stands, the new variants, and as you said, the rollout of vaccines. But it's important to remember that this was not a recession that was caused by bad behavior, the buildup of imbalances, debt, etc. This was a recession that was caused by lockdowns. And as those lockdowns are lifted, hopefully during the course of this year, we should see quite a strong bounce back in global economic activity and global growth, and by implication, company earnings. What complicates matters a little bit is that clearly the longer this continues, you have the risk of scarring. Scarring in the sense of people who lose their jobs, can't find work again, businesses that close down permanently, and also changes in consumer behavior. So people who are shell-shocked from being at home for months and months and months, and maybe they don't go out and spend money, maybe they rather than continue saving money. So that is the risk to the growth outlook. I think that's where the policy response is so important. So we've seen in the developed markets interest rates being very low, central banks being very active, trillions of dollars being supplied from central banks, but also from fiscal authorities. And I think that's where the recent US election is quite important. Just before Christmas, the US Congress passed a $900 billion plan to support, people on unemployment claims, to support small businesses. And now the incoming Biden administration wants to launch another, they say a $1.9 trillion plan. Maybe it's not going to be as much, but it's still going to be another significant fiscal injection from the US. That's obviously very important because America sets the tone for global markets. So I think there is still ample policy support, that plus the easing of lockdowns during the course of the year, and I think we're looking for a pretty strong bounce in global growth in the next couple of months.
So that's a very positive look on global growth. As you said, we've had a lot of support. There's also the chance that we could see investment spending coming through in the US, spending on infrastructure. We haven't seen that before. And I think that raises the question in people's minds of, is there a risk of inflation from here with all the stimulus that has come into the system? The other worry on people's minds, the amount of debt that is being created to provide this support. What are the risks to inflation and from debt looking forward?
Yeah, the inflation question is very important because ultimately it's one of the main drivers of long-term asset returns. So it's important that we get it right. I think you are going to see higher inflation over the next couple of months for two reasons. Number one is because you had such low inflation early last year. You'll remember there was that one incident where the oil price actually turned negative for a short period. So that just creates a very low base, and if you measure it year on year, you're going to see inflation rates rising early in 2021 on a temporary basis. And the other thing, of course, is, as I said, if global activity starts bouncing back quite strongly, that tends to give a bit of upward pressure on prices. So yeah, in the short term, we will see higher inflation. I think our question as investors is more, do we expect inflation to remain higher on a sustained basis? Do we expect inflation to keep rising over the next 3 to 5 years? And there you want to ask yourself, those factors that caused low inflation pre-pandemic, have they gone away? And I don't think they have. So I think you're still sitting in an environment where there's excess savings, excess capacity, globalization, competition between workers across the world from emerging markets, China, India, etc. And of course, technology. The fact that we're doing this today's show virtually, that is a huge cost saving for our business, and that is something that facilitates companies to actually cut costs and keep prices low. So I think inflation is probably going to remain muted once we get past the sort of a short-term bump in inflation rates. And similarly, all the stimulus that's been pumped into economies, that is not a permanent feature. So for that to turn into inflation, you would need to see, $1 trillion stimulus plans next year and the year thereafter, and that's obviously not going to happen. The question on debt, I think, what investors are worried about is, again, that all this debt could lead to inflation, that governments will be tempted to inflate away, all the borrowings that they've undertaken. And I think here the one example we can point to is Japan. It's the most indebted country in the world relative to its own income. And Japan has had persistently low to negative inflation for the last 20 years. So that tells us there's no obvious link between debt and inflation. They've tried to raise inflation in Japan. They haven't succeeded. So this idea that you're just going to inflate away your debt, that's a much harder than it sounds. And I think for the time being, as long as interest rates are as low as they are, governments are not going to struggle servicing their debt. So that's not a worry for the time being. In developed markets, obviously in South Africa it's a different story, and we'll touch on that just now.
South Africa has clearly had an incredibly tough year coming through this crisis. You've painted a very positive global backdrop. How does that support South Africa, particularly for our key asset classes, equity and bonds, going forward?
Yeah, so I think there are two areas where we've benefited. Obviously, there are some areas where we've struggled, particularly in terms of tourism arrivals. In that sense, the global environment has obviously been quite negative. But the important areas where the global environment supports us is, number one, commodity prices actually rose during the course of 2020. And that's against expectations, because typically when there's a global recession, commodity prices actually fall. So we've seen gains in iron ore and coal and gold and palladium, and that helps us a lot. It helps our economy, it helps our stock market clearly, it's helped the rand recover. I think we're going to see a positive benefit in terms of government's tax revenues and potentially a bit of a surprise in terms of the budget when that happens later this month. And that will obviously be good for bonds. So the commodity story, I think, is a very, very positive, underappreciated silver lining for the SA economy at this stage. And I think the second area where the external environment is positive is just in low interest rates. So when you have low global interest rates, it gives our own Reserve Bank the opportunity and the scope to keep rates low locally. Over the preceding 5-6 years, the South African Reserve Bank continuously kept an eye on what the Fed was going to do in the US in terms of raising interest rates there, and I think maintained higher interest rates in South Africa than was what was good for the local economy. And I think for the first time in a long time, they can actually set interest rates based on domestic needs rather than worrying about what the Fed is going to do. So that gives us a window of maybe a year or two where we don't have to worry about rising interest rates globally. And I think that is a big positive for the local economy.
We've always said the external environment is critical for South Africa, providing a supportive backdrop for growth. If we look at our equity market, what has supported returns has been the global shares, as you say, commodity shares, and then the global shares listed here. Domestic shares have really struggled in an environment that has been incredibly tough. We've had low growth for at least the last 5 years. What are the prospects for the economy looking forward that we can actually see domestically focused companies being able to generate decent earnings again?
Yeah, another very important question. I think clearly 2021 is going to be a much better year in terms of growth, but that's just because we're coming off the very low base of 2020, where in all likelihood, the economy contracted in the region of 7%, which would have been a record decline in activity. So we're going to see, basically the rubber band stretching. It was stretched last year and it's going to snap back in 2021. But I think the question is going into 2022, 2023, what does the growth path look like? And I think here there's reason to be optimistic. I spoke about the commodity prices, low interest rates. Those will definitely help the domestic economy and kind of have a rippling effect into sectors that are not directly linked to mining. And then I think we are going to see some progress in terms of the government's reforms. I mean, those things take very long time to impact the economy, but especially on the electricity side, we're going to see substantial investments in electricity generation capacity, renewable energy this year going into the next couple of years. I think that will help a lot. There's some other reforms, the spectrum auction that will hopefully bring down broadband costs and so on. So I think that does give the local economy a bit of momentum. If you look at the Reserve Bank's recent forecast, they expect obviously a nice bounce this year, but then next year and the year thereafter growth of more than 2%. Now 2% in absolute terms is not a lot, but relative to the 0.5% growth we had, pre-pandemic, I think that is a big improvement, and I think that gives local companies, locally focused companies, the opportunity and the ability to really grow their earnings, and that should be positive for our local equity markets.
So lastly, I want to speak about bonds. We've had an overweight exposure to bonds for a long time. We know what the crisis has done to our debt levels. I'm sure there are many people that are cynical, especially if you look at how government has dealt with vaccine procurement. We've held the view that yields are high, inflation is expected to stay within the target bands over the medium term, and therefore the real yield on offer offers investors a good opportunity for returns. What are the risks to this view? Often it feels the journey to curtailing our debt often feels quite fragile. Are we being too optimistic on this asset class?
I mean, I think the risk that you've mentioned are just that there's further deterioration in the government's deficit. But broadly speaking, the risks are known, and therefore they are priced in. And I think one of the big risks, and again that people don't always appreciate, is just the risk of global yields moving higher, of global interest rates moving higher. And I mean, we saw it earlier in 2020 when the COVID shock hit. It was the foreign holders of South African bonds that fled, that panicked, and pulled their money out, and that's why yields spiked so much. So it is the shift in the global markets that is the number one risk to our bond market. Secondly, as I said, inflation is low, so I don't think that is a risk in the medium term. And then in terms of the fiscal consolidation story, I think what's important here is that the market doesn't care about the debt level. The market just cares about the direction or the path. So as long as we can just show that we're stabilizing the debt, I think that will be received very positively by markets. That's obviously easier said than done, and that's a multi-year process. But it needs to start somewhere. I think the government is serious about curtailing the wage bill. That's obviously the one area where they can reduce the deficit. How the detail of that plays out, we'll have to wait and see. But I think there's a commitment to managing the wage bill down. And I think once you go from there, you can potentially build some momentum. And then lastly, as I said, I think there is a potential for tax revenues this year to actually surprise to the upside for the first time in about 8 years. For 8 years in a row, we had tax revenues coming in less than government expected, and I think this year you can actually see that changing for the first time. So I don't think we're being overly optimistic. I think we are realistic about the risks, but I think we also need to be cognizant that this does represent a massive opportunity for investors in the context of global interest rates basically being zero.
So as Isak and I have discussed, there's a big opportunity in South African assets, both in equities and in bonds. Clearly this comes with risks, but we're already coming off a very poor 5 years, a very low base, and many of these problems are being fixed. If we look at markets, they've rallied strongly and recovered strongly from the lows. And then from November, we've had an extraordinary rally in equity as the vaccine has been discovered, and we've had closure on the US election. We know that equities are not cash. They don't go up in a straight line. So one can expect volatility from here, particularly after the strength of the rally. And one, therefore, as always, needs a longer-term horizon for that value to be unlocked. The key is to be diversified. We're building diversified portfolios with a valuation underpin. And our key message today is to stay invested. Things often feel tough and feel uncertain, but if you hadn't been invested in the markets in the last 3 months, you've missed out on a 20% rally within SA equity. And as Charlie Munger says, the big money is not in the buying or the selling, meaning it's not in the timing of the market, but it's in the waiting, in the patient investment for those real returns to be unlocked. Thank you very much.
Thanks, Manine, and thanks to everyone for joining us today. I won't have to remind you that 2020 was a bit of a roller coaster ride. And if we look at what South African equity markets or the South African equity market did during 2020, like all good roller coasters, we ended pretty much exactly where we started. So looking at the returns and the path that the South African equity market took during 2020, what we're seeing on the slide at the moment is the capped SWIX and the returns that delivered over the course of 2020. And if you break the year up, you can really break it up into 2 parts. Firstly, the first part, where the market experienced the drawdown in the first quarter of the year, where it was down roughly around 37% at its low point in March. And in the second part of the year, the subsequent recovery, where the market from those lows rallied almost 60% to end up finishing the year pretty much exactly where it started. But if we look a little bit deeper and look at what the sectors delivered over the course of the year, you'll see that the recovery in the markets wasn't even. And through the course of the year, there were COVID casualties and COVID beneficiaries. Some sectors and some stocks that did well out of the crisis, and others where there was an obvious sell-off and an obvious struggle for those particular companies based on the sectors that they were in. Looking at the lines on the chart, you'll see Strong performance out of the industrials and the resources sectors, sectors that delivered double-digit returns during 2020. But the obvious sector that struggled in 2020 was the financial sector, a sector that is far more of a proxy for the domestic economy than the industrials and the resources sectors, which are far more rand hedges. And if we look a little bit deeper into those sectors and look at the subsectors that lie beneath those, you'll see that even within the sectors, a lot of the recovery wasn't even there as well. Looking at financials to start with, here highlighting three of the main subsectors within the financials sector or industry sector. Looking at the banks, the insurers, and the real estate companies or the property companies. And you'll see that all three of those sectors struggled during 2020. And to a large extent, despite a strong run-up or a strong rally in the fourth quarter of the year, still have a long way to go to get back to where they started the year in 2020. Looking at the industrial sector, that's far more of a mixed bag. And it is very much dependent on the sectors that you were in and also your rand hedge characteristics. Looking at the dark green line at the top, that's our technology sector. That is largely Naspers and Prosus, the two main tech companies in our market that have their fortunes very closely linked to Tencent. Those companies, along with, in line with what other global tech companies delivered, beneficiaries of the work from home environment, the COVID environment, and doing very well in 2020. Looking at two of the other rand hedge sectors, we have the personal goods sector, which is the lighter green. That is Richemont. And the tobacco sector is British American Tobacco, two global rand hedge companies in our market, also holding up fairly well during the market sell-off of March and delivering fairly decent returns through 2020. In contrast, if we look at a sector like retail, retailers obviously impacted by lockdowns around the world, and in particular lockdowns in our own country. But even breaking that sector up even further and looking at the food and drug retailers in blue, they held up a lot better than the purple line, which is your more discretionary retailers, your apparel retailers, because people obviously still needed to go shopping for groceries, but you could probably hold off on your purchase of a new pair of shoes. Looking finally at the resources sector, it was a sector where there were some very big winners, but also some very big losers. The miners did very well within the resources sector, and in particular, if you look at the purple line, which is the gold mining sector, benefiting quite a lot in the first half of the year from a run-up in the gold price. But what you've seen subsequently in the second half of the year is that those miners have actually given up a lot of those gains that were generated in the first half. Similarly, looking at some of the other miners, the diversified miners and the platinum miners, also very good years for those companies as the commodity prices and in particular the pickup in demand from places like China supported the earnings trajectory and the earnings outlook for those particular companies. In contrast, the one resources counter in our market that had a pretty tough 2020 was Sasol. Sasol is in the chemical sector of the resources sector in our market, and during the oil price crash in the first part of the year, that exposed effectively the weaknesses in Sasol's balance sheet. And despite recovering from those March lows, when you fall as much as Sasol did, you have to generate pretty substantial returns to get back to where they started. And Sasol still finished the year, despite recovering from those March lows, almost 50% lower than where it started the year. So I think what the message is in looking at the disparity and the unevenness in these returns is that 2020 was actually a very good year to be an active manager. There were plenty of opportunities to position your portfolios in the sectors that did well or away from the sectors that did poorly. And 2020 really was a year for active management. And pleasingly, if we look at the returns that our managers generated, that comes through in our manager returns. So what we're looking at in this chart is the returns from our South African equity managers net of fees. So this is after all of the manager fees relative to the benchmark, which is the black bar. And pleasingly, all four of our equity building blocks, or our South African equity building blocks, generated outperformance in 2020. The standout manager being Coronation, who delivered outperformance of roughly around 8.6% for the year. Second was 91, a manager that we added to the portfolios in 2019 and have just completed their first calendar year, outperforming by roughly around 5.2%. The boutique managers in our boutique portfolio, which consists of 361, Battelier, and Laurium, also delivered pleasing outperformance. And Prudential, after a very tough start to the year, also managed to outperform the benchmark for the calendar year. The next few charts that I'm going to take you through, we're going to look at how the managers delivered that performance throughout the year. So what we're going to look at is the cumulative either outperformance or underperformance through the course of 2020. What the purpose of this is, and what it should hopefully highlight, is that even though the managers all outperformed, they took very different paths to get there, which highlights the importance of a blend when you put the managers together. Because ultimately, you want the managers in your portfolio to be complementary, to be doing different things. You don't want to have managers that are all doing the same thing, because then you're not getting the manager diversification that you need from the building block when you put it all together. We're going to start with Prudential, which is the red line. And Prudential were a manager that, at the start of the year, there was a fair amount of scrutiny on this particular manager for a few reasons. Firstly, after many years of consistent outperformance, Prudential had had a very tough 2019 and had underperformed their benchmark. At roughly around the same time, in the first part of the year, there were some significant changes to the senior investment professionals within the Prudential investment team. So with that as a starting point, Prudential got off to a very tough start to the year in 2020, underperforming in the first quarter largely due to an overweight position that they had in Sasol. Now, as people who do manager research and in looking at Prudential, we needed to basically go back and retest our investment case and make the assessment that, was something broken with this particular manager that warranted a change. And we did a lot of work in that first part of the year, spending time with Prudential, but also spending time talking to some of those investment professionals that had left to make that assessment as to whether something was materially wrong with this particular manager. The outcome of that work and the assessment that we came to was that even though there had been changes in personnel, this was still a quality manager with a strong investment philosophy and process that we bought into. The people that were underneath the senior investment professionals that made the step up within the investment team were of a high caliber. At the same time, Prudential were able to attract talented investment professionals away from other investment houses. And ultimately, the investment process that this manager runs and their discipline behind that process is what served them well over the course of the rest of the year and led to them outperforming. During the drawdown of March, Prudential didn't panic. And they followed their process of investing in those managers, or investing in those companies rather, where the valuation was on their side and they'd been oversold and valuations were attractive, recycling their portfolio from positions that had done well and held up into more attractive opportunities. And it was this discipline in their investment process that ultimately led to them outperforming come year end. The next manager to take a look at is Coronation. Coronation is a manager that was similar to Prudential under the spotlight a few years ago after a few years of consistent underperformance. At the time, in doing the work and in assessing the manager, we concluded that this was still a quality investment manager, but given the way that they manage portfolios, warranted a reduction in our own building block, just effectively to manage the overall risk of our solution. And what's pleasing to see is that in the manager research that we did in maintaining a longer-term mindset and longer-term outlook when it comes to performance, is that we've been rewarded by having patience with this particular manager with 2 very good years in a row. And I think also important is to assess what they bring to the manager blend. Coronation, in contrast to Prudential, did very well in the first quarter of the year. This is largely due to the portfolio positioning they had, where they had a preference for global stocks and were significantly underweight some of the domestic counters in our market. Overweights in companies such as British American Tobacco, Prosus, and Quilter added a lot of value for Coronation over this particular point in time. Coronation and Prudential have historically been a very good blend for one another, and it's been pleasing to see that trend continued throughout 2020. One of the key challenges that we grapple with as people who do manager research is knowing how to deal with an underperforming manager. And often a lot of the challenge in us for us, and when we appoint active managers, we need to understand that at time there are going to be periods of underperformance. That just comes with the territory of appointing an active manager. But the challenge for us is in looking and making the assessment as to whether that underperformance is a momentary blip and is part of the overall investment cycle and the cycle of that manager's performance, or whether something has structurally broken. And if something has broken and we come to that assessment, that often necessitates a change. In 2019, we made such a change when we appointed 91 to our manager building block. It's still very early days in terms of their mandate, but pleasingly, it's a manager that is doing something quite different to the other existing managers in our solution, and is a manager that, again, delivered value through 2020 and has gotten off to a very good start. 91 did quite well in 2020 from their overweight to the resources sector. And what you can see is this is the manager that led the performance or did very well in their performance as the market recovered in April. Finally, looking at our boutique managers, managers that have a hedge fund background, managers that did well in the market drawdown of March, as you would expect. Of these three managers, the standout performer in this portfolio for the year was 361, who delivered significant outperformance. Battalier, another one of the managers that delivered outperformance, while Laurium marginally underperformed for the year. But overall, the combination of these managers outperforming in 2020 as well. And when you combine it all together, so all in all, looking at how that combination gets put together and looking at how our building block has performed, quite pleasingly, some good outperformance from our South African equity building block for the year, outperforming by roughly around 3.6%. That 1 year outperformance has lifted the performance of the 2 and 3 year numbers, which are now also ahead of the benchmark, and has closed the gap on the 5 year number as well. Looking longer term, the 10 year number also ahead of the benchmark net of fees. And ultimately, this is in line with what we're looking to achieve with the building block. That is delivering consistent outperformance relative to the benchmark that we utilize. Finally, just to round off, looking at some of our positioning and looking at how the portfolio is currently positioned. If we look at the building block relative to its benchmark from a sector perspective, what you can see is, reasonably not too many significant tilts away from the benchmark, but there are some material positions that are worth talking about. Firstly, an overweight to the technology sector. That largely is due to the overweights that our managers have to Naspers and Prosus. Similarly, overweights to the consumer goods sector, which is largely due to the overweight that our managers have to British American Tobacco. So the portfolio is still maintaining a fairly healthy exposure to some of those rand hedges. It's also worth looking a little bit deeper into two of the bigger sectors that we have. Firstly, to start with the basic materials sector, which is largely our resources sector. There's a marginal underweight and over at a total sector level, but if you look a little bit deeper, you can see where that underweight is coming from, and that is largely coming from the portfolio and the managers being underweight the gold mining sector. Within that materials sector, there are some overweights probably worth talking about as well. Within general mining, these are your diversified miners, an overweight tilt to that particular part of resources, largely coming through from an overweight to Anglo-American, an overweight to the coal sector due to an overweight in Exxaro, and an overweight in the chemical sector through an overweight to Sasol. Similarly, in the financial space, an underweight to that particular sector, which is the largest sector in the capped SWIX. And that underweight is largely across the board, where our managers are underweight banks, underweight insurance, and underweight the property companies that we've spoken about. There is an overweight to the financial services sector, which is really a catch-all sector for companies that don't necessarily fit the description of being a bank, an insurer, or a real estate company. And that overweight largely comes through due to an overweight to Quilter. So again, some rand hedge exposure within there. If we look at the outlook for the South African equity market and looking at the valuations and in particular the outlook for earnings growth, the two charts on this particular slide on the left-hand side are the forward PE ratios for the various sectors as well as the South African market as proxied by the All-Share Index. A forward PE ratio at the end of December of 11.1 times, which roughly translates into an earnings yield of around 9%. From a valuation perspective, that is a fairly attractive earnings yield, and the market's still trading on fairly cheap valuations based on these forward PEs. And looking at the expectations for earnings growth, which is the chart on the right-hand side, you can see a fairly substantial expectation that earnings growth will rebound in 2021, obviously off very low bases created by the depressed earnings of 2020. But effectively where that earnings recovery is coming from is largely from a bounce and a recovery in the South African financial space, but also the continued earnings growth within the technology and the resources sector. There's obviously a lot of forecast risk to these particular numbers, especially as we're still waiting to see how everything related to the pandemic and all of the uncertainty there plays out. But a strong recovery expected in the earnings growth for South African companies. That ends my slides. Thank you for your time. And I'm going to hand over to Andrea now, who's going to talk you through global equity.
Thank you, Michael, and good afternoon, everyone. Now, going into 2020, investors were cautiously optimistic about global equities, given that we're finding ourselves at the late stages of a global economic cycle. However, no one could have predicted the events that have unfolded during the first 3 months of the year, as big parts of the global economy came to a complete standstill in response to the pandemic. Now, despite these unprecedented events, global equity markets managed to end the year on a very strong note, with the MSCI ACWI index delivering a positive 16% in US dollars. However, the positive outcome certainly masks the massive drawdown experienced by global equity markets in March, with the index losing about a third of its value from the peak it has reached in February, earlier in the year. At the same time, it's worth noting that the recovery in markets was just as sharp and swift, with the MSCI ACWI index recovering or bouncing back some 25% during the last few days of March, and gaining just over 70% by the end of the year. Despite the positive outcome achieved by global equity markets, it's worth noting that market performance was highly uneven throughout the course of last year. So, for instance, if one looks at the sector performance throughout the course of the year, one would note that cyclical or economically sensitive sectors were hard hit by the lockdown across major economies throughout the world. The companies that populate these sectors also tend to have more levered balance sheets compared to the broader market, and they also tend to have high level of inflexible asset base as well as high level of sunk assets. Now, all of these characteristics tend to put additional downward pressure on those companies' profitability during a recession. So, in the chart behind me, for instance, you'll have the financials and the energy sectors, which were the two worst performing sectors throughout the course of last year. Neither of them having been able to get back into the green by the year end. So energy finished the year still some 32% down in US dollar terms, while financials were still about 3% shy of an absolute return for 2020. On the other side of the spectrum, we had COVID beneficiaries. So for instance, businesses, particularly within the information technology sector, which benefited from, for instance, the work from home environment, which prevailed from March onwards, propping up the information technology sector some 44% for the year. Second in line, consumer discretionary delivered a 37% return for the year, being supported to a large extent by retailers, which with already established e-commerce capabilities. A similar divergence in performance can also be noted when dividing the global equity market between the two broad investment styles, value and growth. With the value side of the market clearly being more populated with the cyclical or economically sensitive type sectors. And it doesn't come as a surprise to see the value index behind me in the darker shade of green, ending the year flat, whereas in contrast to that, the growth index was up just over 34%. A similar divergence in performance can also be noted when one compares the performance of the various broader regions across the world. So starting off with the MSCI USA index in brown in the graph behind me, which was up just under 21% in US dollars. Contrast that performance to the MSCI Europe in the lighter green, which was up just over 5%, a little bit over 5% in dollars. Now, that divergence in performance doesn't come as a surprise, given that the US market tends to have a much greater tilt towards the better performing information technology type sectors, as well as e-commerce retailers. On the other hand, Europe tends to have a much greater exposure to the old economy type sectors, which tend to be more cyclical or economically sensitive in nature. Emerging markets in general also posted a very good return for the year, up just under 90% in US dollar terms. China, as well as other Asian markets or economies, were able to better handle the shutdown of their own economies, as well as the subsequent reopenings throughout the year, and that coupled with the fact that the emerging markets index also tends to have a bias towards information technology type companies, as well as digitally enabled businesses, e-commerce retailers, etc. Those characteristics have clearly supported the emerging market index performance throughout the year, allowing it to sort of keep pace with the US market, particularly during the second half of 2020. The divergence in performance, whether at sector level, style or regional level, is really welcoming, as it offers active asset managers a fertile ground for mispriced opportunities. And our managers have certainly taken advantage of that, picking up a number of businesses which they have followed and admired for some time, but which never really traded at attractive enough prices. Just a brief reminder of the manager allocation within our global equity strategy. We aim to have a balanced exposure to the broader investment styles, value and growth. Within the value basket, we have Orbis, which also has a more contrarian nature, as well as Harris Associates, while the growth basket is populated with Baillie Gifford, as well as 91, with 91 bringing a sort of more defensive streak to the strategy through its quality focus. About 11% of the building block is invested in emerging markets via Coronation and Federated Hermes with equal weights. It's worth noting, though, that all four global equity managers that I mentioned previously have the ability to invest in emerging markets as well, should they find the opportunity set to be a lot more attractive in that region. And certainly Orbis and Baillie Gifford have taken advantage of relative valuations and have maintained meaningful exposures to emerging markets throughout the course of last year, as well as previous years. Therefore, on a look-through basis, the emerging market exposure of the building block currently sits at about 20%, relative to around 12% in the index or the benchmark. The global equity strategy outperformed the benchmark by around 2.4% during the course of last year, after taking into account all underlying manager fees and costs. And that is indicated by the green bar, the darker shaded green bar behind me. The biggest positive contributor to that relative performance was Baillie Gifford, our growth manager, and that's primarily on the back of its extensive exposure to digitally enabled businesses as well as tech platforms. 91 also posted a very good return, pretty much in line with the benchmark for the year. On the other hand, the two value managers underperformed the benchmark throughout the course of last year. Orbis did so to a much smaller extent, lagging the benchmark by only less than 1%, while Harris Associates lagged the benchmark by about 7% throughout the course of last year. In the emerging market complex, which can be found on the left-hand side of the graph behind me, both active managers, Coronation and Federated Hermes, were able to contribute meaningfully to performance of the building block, as they outperformed their own benchmark, the MSCI Emerging Market, by quite a large margin, about 4% and 6% respectively. But they also managed to outperform the broader MSCI ACWI index. It's worth noting that our aim is certainly not to shoot the lights out in any given period. Rather, our objective is to build portfolios that aim to offer a balanced and consistent outcome for our clients, and we do so by combining asset managers with complementary investment philosophies and investment processes. And those complementary investment styles come through quite vividly when one looks at the performance or relative performance between the various managers experienced throughout 2020. For instance, the divergence in performance between Harris Associates and Baillie Gifford, obviously as a result of their more sort of value and growth style biases within their own portfolios. On the other hand, Orbis, although they do have a value tilt, their more fluid nature allowed them to have a more balanced exposure to those two areas of the market. 91, our quality growth manager, benefited from their defensive nature throughout the course of 2020, and were able to protect capital to a much larger extent when compared to the index, outperforming the benchmark by some 9% during the first 3 months of the year, in which we've obviously noted global equity markets losing quite a bit of their value. However, as expected, the manager was unable to keep up with the market recovery and underperformed the benchmark for the balance of the year, therefore giving a return from their fund pretty much in line with the benchmark during that time period. It's also worth noting that the relative outperformance of our global equity strategy was achieved despite the building block having quite an underweight position to the US, currently sitting at about 16% versus the benchmark, as indicated in the graph on my left-hand side, whilst also maintaining an overweight exposure to Europe and UK. On the other hand, a high exposure to China versus the index, as well as other Asian markets, certainly were helpful for the building block's relative performance throughout the year. From a sector positioning perspective, the building block maintains an underweight exposure to the resource type sectors, including energy and materials. It also maintains an underweight position to real estate or property, as well as to healthcare. On the other hand, the building block continues to maintain an overweight exposure to consumer type services, like those found within the discretionary as well as staples sectors, an overweight to financials as well as communication services. Global equity returns throughout the course of last year were predominantly driven by a re-rating of markets, given that company earnings pretty much plummeted. Given the current market valuations, it is quite clear that investors are looking through the current earnings trough, expecting a sharp rebound in company earnings to be delivered throughout the course of this year, with additional growth expected further out in 2022. And all of this likely supported by the hopes that the vaccines will allow us to get back to a more normal economic activity. Currently, the US is looking fairly stretched from a valuation perspective, with the latest P/E ratio denoted by the green diamond fairly close to the maximum point registered within the US market over the last 30 years or so. On the other hand, there are other regions around the world where valuations look a lot more attractive on a relative basis, such as, for instance, in Europe as well as UK. Nevertheless, both developed markets and emerging markets seem to trade on very similar valuations when compared to their own histories. As mentioned previously throughout the presentation, one of the key risks to current valuations is that company earnings will disappoint and they will not materialize. However, it's probably good to remember that the current valuations are only broad representations of the underlying indices, and our own managers continue to find attractively priced opportunities across the board. I would also like to spend a little bit of time just chatting to you about our global range of UCITS funds. This is a range we successfully launched in February last year, and it is currently available for new investments through the Old Mutual International platform. In fact, the funds are part of OMI's core range, which means that they attract a preferential access fee. We are also pleased to inform you that the funds have recently received Section 65 approval by the FSCA, which obviously means that we can market them to local investors. These funds are managed using the same philosophy and process which underpins our local strategies, and they've been modeled to deliver inflation-beating returns after taking into account strategy fees as well as underlying asset manager fees and costs. So for instance, starting off with the left-hand side of the risk-return graph behind me, Global Moderate Fund is a typical balance type strategy aiming to achieve a real return of 3% over time. Global Growth tends to be of a more aggressive nature with high exposure to growth assets such as global equity and global property, and aims to deliver a real return of 4%. Again, after all underlying fees and costs. And on the right-hand side of the risk-return spectrum, we have global equity, which aims to deliver a real return of 5%. Given that these funds don't yet have a one-year track record, as the launch date was in February last year, we unfortunately will not be able to show you those performance numbers. However, as testament to our ability to manage offshore assets and the success of that, I would like to share with you the track records of the CIS Global Inflation Plus funds, a range of funds which the All Mutual Multi-Manager Investment Team has been managing for the last 15 years or so. These funds are managed, again, using the same philosophy and process, which underpin all of our strategies, each having a real return objective in mind. So starting off with the CIS Global Inflation 1 to 3 fund, it's pleasing to see that the fund was able to outperform its inflation plus 2% target over different time periods. Obviously, with a good performance coming through from global equity markets, propping up those shorter-term returns, particularly over the last 5 years. A similar picture emerges when we look at the Global Inflation 3 to 5 fund. Again, the fund comfortably outperformed its inflation plus 4 target over time. Similarly, the Global Inflation plus 5 to 7 fund, which is pretty much a typical global equity fund, was able to deliver a similar outcome, outperforming its real return target of 6% over different time periods, and again with the strength in equity markets coming through quite predominantly during the shorter time periods. And on that note, I would like to thank you for your attention and your continued support.